Welcome to F.A.C.E, Stephen Aniston. I'm making you the presenter, looking forward to meeting you. And everyone will learn that VIX is not a cough drop, although you can choke trading it.
Okay. Can you hear me now?
Yeah, I hear you loud and clear, Stephen, a.k.a. Stevie VIX. How are you today?
Good. Glad to be on here with you guys. Very nice presentations. Appreciate it here.
Thank you very much. Very nice to meet you too, and timely topic. So I went to your website, read a little bit about it. So the beginning of your journey was as an IT guy. Is that correct, Stephen?
That's right. Yeah, I was a technology manager at big banks for about 15 years. Yeah, I worked at Bank of New York, Royal Bank of Scotland, Goldman Sachs. Yeah, so I kind of did a tour over there.
Did you get the trading bug there while you were doing IT?
Ironically, I got the trading. Yeah, at Goldman, I was kind of in the merchant banking division. It was mostly private equity, so doing a lot of valuation stuff. But really, I got the trading bug in RBS because I was working with the institutional research people. So they were sending out these, a lot of research for, gold prices and S&P 500, and that's where I actually got the bug.
Well, that was a good place to get the bug because they had some probably very competent technicians, fundamentalists, or they wouldn't be on the payroll. So, I know a lot of people like to fade banks, but, banks don't pay people six figures as analysts, and I don't know if they even do anymore, but unless they have a proven history of being able to see the market. So did you gravitate more towards technicals or fundamentals? Who was a big influence on you in your trading life?
Well, I kind of look at everything. I don't have an approach of like one or the other. I just go with everything, So everything is meaningful information. Everything is used by somebody, and everything matters. So that's my view of it.
All right. So also read you started this website out, VIX Contango, as a hobby, and there was just so much demand for it. You turned it into a professional website. So really the key thing to address is, I know selling volatility, because there's a lot of decay in the instruments, Stephen, is a bit similar to people who write options, correct?
That's right. Yeah.
Okay, so you have the decay happening in these instruments just like you do on puts and calls, and it's like picking up quarters on the sidewalk until a steamroller comes down the street. And I would say that what happened in February was definitely a steamroller. Were you able to get out of the way of a short vol strategy before that spike to 50? Did you see it coming? How do you manage risk, even though it only seems to happen every few years?
Yeah, I mean, we basically I'm right now I'm a VIX-based investment manager. So I'm an investment manager who pretty much invests in volatility instruments only. And while over the last couple of years, selling volatility has been the right trade and a good trade. I'm not necessarily a one-trick pony, so to speak. We don't view the market as just having a single direction. A lot of people basically like to sell volatility because it's the same trade as being long the stock market. But it's kind of a leveraged play on being long the stock market, so you make more money, right? So
yeah, a lot of people got blown out of the water, and even a few instruments ended up not functioning well. So,
but
go ahead.
Yeah. But that's not my view. I'm kind of basically long short, so I would play long volatility as well as short volatility.
I see.
Depending on how I read the situation.
Okay. How did you navigate it when it happened? Were you surprised at 50? I mean, 50 happened the last time was with a wand evaluation. I think it was, 2015?
Yeah, I mean, no, we've been, we were short volatility for the last couple of years, but basically right around when they passed the tax cuts, we went long volatility. So we've been kind of we've been on the side of long volatility since then. So I just I think that's going to be the right trade for the next couple of years, and I don't think short volatility is going to pay. I mean, we already saw how everybody lost their money, and that's going to continue for a few more years.
To me, it looks like up until except for a few exceptions, the VIX chart looks like an EKG of someone in a coma. That every once in a while he gets electric shock treatment, and I'm curious if you think, since a lot of people can call this an asset class or do call it an asset class, whether or not we could get trends in the VIX instead of dormancy and then spikes and then dormancy and then spikes. Do you think the regime has changed? We're putting in higher lows even though we're under 20, that that was kind of like the volcano woke up, and even though we're not spewing lava right now, that this is the beginning of an uptrend in volatility, and it could be more of a technical trading market instead of just doing nothing and then doing something spectacular?
Yeah, well, it was, I would say this was kind of the tremor before the earthquake. So, our basically thesis for this year is that we're going to see volatility normalization. So in 2017, we saw extremely low levels of volatility, right? I mean, record levels of volatility never seen before.
Right.
VIX being below 10, in single digits for 40, 50 days. Whereas before that, the total number of such days was like 4 or something like that. So this year we think that volatility is going to normalize, and the normal average of the VIX is about 19, but we think this is also a structural change in a volatility regime that's going to continue to go up, to go higher after that as well.
Why? Because of the contango? Just guessing.
Well, the reason for that are basically fundamental. So I do a lot of fundamental analysis on my website. So we look at corporate earnings, corporate earnings growth, and valuation levels. I mean, I have a model kind of how to predict volatility, right? It's I call it an EVIL model, EVIL.
Okay.
And it's each one of them stands for: E is for earnings growth, V is for valuation, I is for implied correlations, and L is for liquidity. So just to so first we look at earnings growth, right? Is earnings growth there or not, right? That determines then valuation. So then you look at valuations. If the valuations make sense compared to the earnings growth that is projected, right? Sometimes valuations can be above it, sometimes below it, right? So there's different opportunities. Then you look at implied correlation. So you look inside of the sectors and see which sectors are overvalued and how big they are, right? Is there a lot of skew in there? Because basically, if your biggest sectors are overvalued, right? And then people need to sell them, and there's no place basically to put the money, then volatility has to rise. People have to hedge, okay? And the movement of the index becomes bigger. And finally, we look at liquidity conditions. There's money coming in and out of it. So can I share the screen? Maybe I can kind of go over some of these things and kind of explain the thesis.
Yeah, sure. We're looking at your screen.
Oh, you're looking at my screen. So
yeah.
So are you seeing the VIX Contango website now? Or
yes, correct.
Is that what you're seeing? Okay. So I mean, I think you have questions that you want to ask me. Just keep asking me, then maybe I can go into that part later on. I had some charts that I created.
Yeah, go ahead. Show us what you got, buddy. Appreciate you thinking about things you wanted to talk about. It's foreign to most people. Even though I trade it, I don't know everything about it. So you're the VIX expert in here right now. Why don't you give us a little tutorial on things you look at?
Sure. So, ultimately the VIX is the sexy part, but to get to there, right, you need to base it on something, right?
Right.
So the first thing, we kind of look at, for example, is the earnings growth. I mean, you hear that on TV all the time. It's a legitimate thing to listen to. But basically, if you look at this year, earnings have got, earnings normally go down throughout the year, but this year, because of the tax cut, right, things have kind of changed. Earnings this late into the game for 2018 have actually gone up a lot, right? So right now they're sitting at 154, right, for next year. So, in a lot of ways, this is as good as it gets because I expect this thing to go down like this,
Okay, so for the tax package made it front loaded, and it's aberrational what's happening right now because of it.
That's right. But the thing you got to understand is what the market looks at is it looks at next year. So it looks at the 2019 earnings and then the earnings growth. So it looks at that difference here between this and this, right? And well, for example, for the previous year, right? If you look at 2018 and 2017, right? 2017 is 109, right? And you get to 154. I mean, this is a huge bump, right? That's why the market went up last year, because it's looking at this huge, this huge difference. Like, okay, we got to front run that, right? And so they front ran it, but you see now the market is not accelerating, even though people are giving it good earnings. Why? Because the market is looking at next year. So it's looking at this difference here, and this difference, this year is setting up a very high watermark, and this difference is very small. It's about 10%. Right.
You sound like the Caterpillar guy. Wasn't it the Caterpillar guy said we reach a high watermark and the market sold off? Yeah. Okay.
Yeah.
Go ahead.
So you look at the growth rate, right? It's in 2018 is great, but you look at next year, it's starting to become single digits, 10%, and this is usually it comes down from that as time goes by. So the market you're looking at right now is basically looking at 10 years 10% earnings next year. And so then what is the right multiple for that, right? So then you go to the question is, what is the right multiple for this type of earning growth? So if you look at the multiples based on whether on a trailing or a forward basic, they're very expensive. I mean, you look at 2016, this is a chart that goes back 3 years, but, we're basically in the 20s, right? On a gap or non-gap basis, we're 20 multiples. So 20 multiple usually goes with earnings growth of about 17, 18%, right? So it makes sense for where we were last year. Does it make sense for next year, right? If you go to earnings growth of 10%, you normally look at multiples of 12, okay? So you're no longer talking about multiples of 20, you're talking about multiples of 12, 13, and 14, which is, by the way, I actually want to go back a couple years. If you look at here,
it was kind of the norm, right?
Yeah, this is the norm. This is, you look at this number here, 147. This is actually the first time we had premiered earnings of about 150. This was for 2015 year, okay? So this is in 2014, we had this. And do you remember what the S&P 500 traded in 2014? 1,800, right? It was 1,800. Right. So the multiple was 12.
You didn't give me a chance.
Huh?
You didn't give me a chance to answer, buddy.
Sorry.
All right. You're like my college professors.
Right.
A college professor once asked me this, Stephen, what's worse, ignorance or apathy? And I said, I don't know, and I don't care.
I would have answered arrogance.
All right. So let me ask you this. So, do you take into consideration yields moving up from where we were before to, the 10-year trading at 3 into your model at all? Does it play in?
Yeah. So the yields, I mean, the market basically right now has a greater fool problem. So everybody's out there trying to pitch you this great story, and obviously what they're finding out is people are selling into it. And the reason why people are selling into it is because yields are going up, and particularly, if you look at the yields, the thing to understand, I don't know if people understand that, basically long-term yields are kind of a function of the growth of the economy, right? So they kind of more correlate to GDP growth and nominal GDP growth, right? So that's why they kind of been very difficult to rise. The 10-year yield, it's still 3% or so. It should be 4 or 5, if you had a good economy. But the front end of the curve, the 2-year yield, the 1-year yield, the 6-month yield is basically very responsive to inflation, right?
Right.
So inflation has been picking up. I mean, if you look at the inflation indicators, they're all above 2%, and they're going to go to 2.5% to 3% over the next 6 months. So yields have risen a lot on the short curve. So if you're an investor right now and you look at, like you can buy a 1-month treasury, it gives you 2% on a year, right? I mean, and it's going to be 3%, within 6 to 9 months.
Which is pretty good compared to 0.5.
Yeah, it's fantastic, and it's better than the S&P 500 yields. And you're looking at stocks which are overvalued. So you have all
the competition. Good. So even at these low levels, because valuations are so stretched with the charts that you've showed us, that even a move to 2% yields is competition for stocks.
It's competition for stocks, yeah, and that's why the chart that I have on the screen right now is showing how the S&P 500, the SPY fund flows have been basically negative all year. As these yields rise, as these short-term yields rise, basically people are just going to Treasury Direct and stuffing their money in. That's what I'm doing. So that's what I'm trying to say. The market, has a greater fool problem. Like if you buy the stocks here now, you need to find a greater fool to sell them at a higher multiple. And so who's going to be that guy? I've talked to a lot of investors. I have client accounts. I mean, everybody's basically, I've been through 2000. I've been through 2007. I don't want to repeat the same mistake again, right?
Right. So does that the fact that people are worried about it, could that almost be a bit of a contrarian indicator that the market has legs because, sometimes it takes time to turn a battleship around?
Well, so speaking of basically the multiples, right? I mean, if you look at $170 earnings for 2019 and you assign a 12 to 14 multiple, which is where it should be, right? The S&P 500 should be in a 2,000 to between 2,000 and 2,400, right?
Okay.
I mean, we're way above that, right?
Okay.
So you got to ask yourself, right? I mean, you've had like 4 months this year. Why are we not at 2,800? Why are we still at 2,650? Right.
Right.
You've had 4 months. You had the shock drop. You had the recovery. Now the question is, why aren't you higher? Right. It's been 4 months.
Why? The bulls could say, why haven't you taken out that Feb low? What's taking you so long?
Well, I mean, generally first of all, we're through the first half of the year, which is the best part, and you have a lot of flows.
So you think we might have a sell in May and go away? Might be happening this year.
I mean, it hasn't happened the last 5 years, but at some point, we're going to have a negative May, right?
Mm-hmm.
I mean, it's
May. Except for my birthday on the 27th, it could be a negative May. So, Stephen, how are you playing it then? If you're long vol, what are the best instruments for retail traders? Because I'll tell you the truth. I bought TVIX before, and that has one of the biggest decays. Are there VIX instruments that don't have as much decay that people could be long vol with? How does a average trader get long vol? What are your preferred ways to do it? With options, with ETFs?
I trade ETFs. I trade the TVIX. I trade the VXX. I trade X.
Do they all have the same decay rate? Or do some have less decay?
Well, TVIX is a leverage instrument, right? So whatever the decay is, it's double that. So that can lose money very quickly. Right. Now the thing you got to understand is for the VIX trade, right? Is basically we look at the spread. Basically you look at the decay, right? So the decay is the contango or the royal, right? So right now it's a little bit kind of about 2%, but for the entirety of the year, right, we have had a very flat curve, right? I mean, contango is basically 0%. The royal, the average for the year is 0%, right? So it is it's let me just show a report here. So if
And
you
wasn't there a case, Stephen, where the front month was trading at a premium, where there was backwardation
that's right.
before the spike? So there were a few tells, and the one tell I noticed was during the final week or two of the S&P blowing off towards 2,800, the VIX wasn't making new lows. It was putting in a higher low above 10. You know, we weren't in the nines anymore. We're trading 10.5. But also you could look at backwardation as being a signal. Are we in backwardation now?
So we were on Thursday. Then that thing moves up and down a lot, but basically we have been in backwardation for majority of the year, right? This is kind of what I'm trying to show you. Look at the contango, which is basically whether you're contango or backwardation. It's on average negative this year, right? So you look at all these years, you have 9%, 8%, 4%, right? This year we're flat, right? We're basically we're at the same level as 2008. So what I'm trying to say is, like, yes, there is a decay normally, right? We've seen in prior years, but this year there is no decay, so you don't have to pay money to hold VIX because the curve is flat. So if TVIX and VIX have fluctuations this year, is because they fluctuate together with the VIX, right? The VIX itself moves up and down, but there's no structural decay this year.
Okay, so this is the best time to own these instruments since 2008.
That's right. I mean, basically the market is telling you need to be long VIX here because it doesn't cost you any money to be long VIX.
Yeah, okay. What a great point. So I did my TVIX trades without this knowledge, and they melted away. So it's interesting that that 2008 is the last year. Do you have any stats for 2000? Was it like that before the dot-com bubble?
Well, the stats for the VIX futures market go down to 2000.
Oh, yeah, that's right. They weren't around yet.
Yeah. But no, if you look at the dot-com bubble, you likely would have seen, a very flat curve because the VIX was very high at the time. I mean, the VIX for 6 years was like at 25, average 25, 26.
What a great presentation. I learned quite a lot from you today, Stephen. I really appreciate it.
Yeah, I mean,
anything you wanted to wrap it up with?
Yeah, I just wanted to say, if when you look at volatility, a lot of people just look at the VIX, and in this thing, you need to look at more than just the VIX. You need to look at the VIX futures market, the spreads there. You need to look at the VVIX, how volatility is moving around. You need to look at the VRP, volatility risk premium. This is actually the one last thing I wanted to kind of finish the presentation with.
Go ahead.
The volatility risk premium. So this is the difference between the VIX and the realized level of volatility in S&P 500, right? So this is how most people trade it, right? And generally the VIX trades at a premium to realized volatility, so about 30% above, right? So if you look at this chart here, right, the VIX has been very, it is very bizarre. So the S&P 500 has moved a lot. We had big February and March moving up and down, but the VIX has been very suppressed. Like if you look at this chart, the VIX basically over the past 60 days has been going down nonstop. It's basically 2/3 of the time has been going down. So what we have here is a year where the VIX is actually below realized volatility levels, right? It's a very bizarre outlier year, right? You see, normally it's around here, right?
Yeah.
This number should be here.
They're giving them away. No one wants them.
They're giving them away, exactly.
Because people that have tried it to be long these instruments through the last few years have lost most of their money. So they don't even want to try it anymore. And I also heard from a lot of people before we had the break in February that people got tired of buying puts or any kind of volatility protection. They said it was a waste of money until it happened. You know what I mean? They gave up. They're going, well, why am I buying insurance? I've never needed it. And then they, without it, they had February. So
well,
I tell you what.
If
Go
you
ahead.
talked to me last year, I would have told you, like, why are you going to be buying insurance ahead of a 20-25% earnings growth, right?
Yeah, yeah. All right. Well, that brings me to a great point for people that are interested in trading and learning about the VIX. Why don't you put your website back up there and show people where they could reach you at VIXcontango.com. They could find you on Twitter at VIXcontango.
That's right.
And you have a subscription for to serve the self-directed trader, not just institutions.
Yeah, most of my clients are, retail traders. I have a few financial advisors, but it's mostly retail investors. Yeah.
Okay. And do you have any type of trial, or what's the rate per month to be a subscriber?
So we're about we do quarterly or annually, so it's about $1,200 per year, so roughly about $100 per month.
Okay.
That's what we recommend to people. We have we issue alerts. We have a few algorithms that issue alerts. I also issue discretionary trade alerts, what I think people should do, that not just technical based alerts. And we have a lot of reports and a lot of kind of dashboards to follow these indicators that I just mentioned. So track about 20 volatility indicators along with fundamental data, in a way that generally is not available out there. And that's generally what people sign up for.
Okay, well,
yeah.
Go ahead.
Our returns trading the VIX have been, around 50% over the past 3 years per year. So
wow.
This is an instrument that moves a lot. We're not perfectly capturing the moves, but something moves like 100 to 200%. We're usually on the trend. We're on the right side of the trade, and we capture about half of that.
Well, thank you so much for coming in and edifying the F.A.C.E community and me about VIX and showing some real key charts that I, never considered before. Really appreciate this, Stephen. I'm glad I reached out to you, and perhaps we could do this again down the road. And you're now my trading warrior brother. So thank you very much, Stephen.
Sounds good. Thank you for having me.
All right. Everyone, that's Stephen Aniston. You can follow him at VIXcontango. Go to his website to learn about the VIX. See everyone tomorrow for Turnaround Tuesday. Remember, don't just count your pips, whether it's in VIX or currency or anything else. Count your blessings. See everyone tomorrow. Adios. Thank you, Stephen.
Bye.